Hey, how are you? This is James Williams. I'm your Marine Corps realtor. I've trained hundreds of agents over the last 20 years. I just want to talk to you a little bit about credit score, what it is, and how it affects your business. Okay, so let's talk about the basics of credit score. Um, Number one, credit score is just a credit worthiness measurement or a metric. That's all it is. And it tells people, are you a credit worthy person or not? It's used by lending institutions, businesses, and real estate when you're trying to buy a home. What are lending institutions? Say, for example, you go to I don't know, a Macy's or a Best Buy, and you want to get a store credit card. Well, the first thing they're going to do is run your credit and determine whether, one, they're going to give you the card, and two, how much space they'll give you on that credit card. Will it be $1,000 or $5,000? From a business perspective, when I first joined the Marine Corps, I had a secret clearance, and later in my career, I got a top secret clearance. The first thing they did, they said, listen, well, let's run James's credit to make sure that, one, he's credit worthy, he has equity, he doesn't have a lot of debt, because if I'm not credit worthy and I have top secret information, I could easily be manipulated to sell the documents in order to get money. So that's why they do it. And then lastly, for real estate, if you're going to buy a house, this determines, how much interest rate that you'll get, and also it'll determine if they'll give you money at all. So we're going to just talk about how credit affects your real estate. So let's talk about that. Okay, so I went to Experian.com, and they sort of broke it down into 5 different areas. So your credit score starts at 300 at the low end, up to 850 in the high end. So if you're between 800 and 850, you're considered an exceptional creditworthy person. Between 740 and 799, you're very good. Between 670 and 739, good. 580 to 669, fair. 300 to 579, poor. What I found that most lenders like to see people at 640 and above. They can definitely go lower, but it makes it easier if your score is a 640 or above. Okay, so what is a credit score, and how is it, how is it computed? At a very high level, we're going to just touch on five ways that they look at your credit score to compute the score. One is your payment history. What does that mean? That means that you're paying your current debt on time, and you've had it for many years, not weeks, but years. So they want to see that you've had credit and that you've done it for a long time. Second, amount owed. So it's called a debt to equity ratio. So they want to make sure that you're, not, you have enough cash to cover your bills. So it's a debt to equity ratio, and that's 30%. Next, length of credit. What does that mean? So a lot of times when people come from overseas or they're straight out of high school, they don't have any credit. So the first thing that I tell my clients to do, get 2 or 3 credit cards, use them, don't max them out, use them and pay them off. And that way, you go back to the number 1, which is payment history. You increase your payment history, and you show a pattern of paying off your loans. So 15% is length of credit. The next one is new credit. I tell people, when you buy a house, within 6 months, don't get any no new credit cards. Why is that? Because when they look at your whole portfolio, they say, okay, this guy has 2 credit cards, each of them have $10,000 of available on each card. Now, if you get a third card, now you have $30,000 worth of available income, not income, but of available debt. So no new cards until after you buy your property. And then last is types of credit. You have revolving credit, you have short-term credit, you have long-term credit. Good credit is home loans. Excellent. Revolving credit, a lot of it is not a good thing. So what they're looking at is, does he have $100,000 worth of revolving credit, which means credit cards, or does he have a $100,000 student loan? They view those very differently, and that represents 10% of your credit score. Okay, so why is this important? and who's looking at it? So you have three bureaus, Experian, TransUnion, and Equifax. Now let's say the scenario is, you have a client, he has a 690, 780 with TransUnion, and 760 with Equifax. The lender is going to use what's called the middle score. The middle score is not the average of the three, the middle. Every bank, every institution, they use, some use Experian, some use TransUnion, some use Equifax, and even the fourth bureau. But whatever it is, they try to get a total picture of what you're looking at. So why, if the credit from Experian is 690 and TransUnion is 780, why is it different? Well, because they have different information. There's times when sometimes you're, you look at that you have 4 credit cards and Experian, and TransUnion only has 3. Well, maybe that third credit card or the fourth credit card has been closed, and TransUnion didn't get the memo. Those are ideas of why it does happen. It's about the reporting. Okay, so why is this important? How does that impact you? Well, if you look at the top row, a client has an 850 credit score. That means he's a low risk. His sample interest rate is 6.49%, which means his monthly payment on the $300,000 loan is about $231 per month. Another client has a credit score of 475. He's considered a high risk, the worst risk in fact. His interest rate, instead of being 6.49, it'll be 2 points higher at 8.29%. How does that affect him? Well, that means his monthly payment, instead of being $2,231, it'll be $2,587. So he's going to pay an additional $300 per month. This is true whether it's a home loan, auto loan, whatever the case is, your credit scores will impact your interest rate. Okay, so here's some quick tips. 1, establish credit as soon as you can. If you're fresh out of high school, fresh out of college, are new in the country, get 2 or 3 credit cards, even if they're only $1,000 limit, it doesn't matter. Get them, start using it, establishing that pattern of paying your bills on time. Number 2, make monthly payments on your credit cards and keep the balance low. Just because you have room to buy more stuff, you don't necessarily have to use it. Number 3, get rid of old credit. Don't get rid of old credit cards. Remember, we talked about payment history representing 35%. If you start cutting up your old cards, then you're losing all that history. Number 4, don't get new credit cards prior to buying a new house. Remember, new credit is not a good thing. If you need new credit, wait till after you buy a house and then go ahead and have at it. Last, check your credit on an annual basis. Just like you get your health, checked, once a year. Same thing with your financial health. There's different websites out there. Experian has one, I think. There's Credit Karma, etc. But look at your credit and see if there's any erroneous charges on there. If there are, go ahead and get it taken care of. Writing letters and showing proof that your credit was stolen and get your credit back is very important. Anyway, thanks for your time. If you have any questions, feel free to leave me a message. I'm James Williams, your Marine Corps Realtor. Hoorah!